Every day, somewhere on social media, you see this narrative. Retail traders can't win. The whole system is rigged. Hedge funds have supercomputers, insider connections, teams of PhDs, and more capital than you'll ever see in your lifetime. You're playing poker against someone who can see your cards. That's what they want you to believe. And look, some of it is true. Institutions do have advantages. The part nobody mentions, they also have massive disadvantages, structural weaknesses baked into how they operate. And those weaknesses are your strengths. Today, we're breaking down 5 real, concrete reasons why a retail trader sitting at their desk with a laptop and a trading plan can outperform funds managing billions of dollars. These aren't motivational platitudes. These are structural edges. And by the end of this video, you'll understand exactly why being small is your biggest weapon. Reason number 1, you can enter and exit any position instantly. This sounds obvious, but it's one of the most underrated advantages in all of trading. When a hedge fund managing $2 billion wants to buy a stock, they can't just click buy. If they tried to dump $50 million into a mid-cap stock in one order, they'd move the price against themselves before they were even half filled. So what do? They spend days, sometimes weeks, building a position slowly and carefully, using algorithms designed to hide their activity, iceberg orders, VWAP execution, and dark pool routing. All of that infrastructure exists for one reason. They're too big to move freely. You don't have that problem. You see a setup, you take it. Full position, one click. The market doesn't even know you exist. And when it's time to get out, same thing. Gone in a second with no slippage, no market impact, and no algorithmic execution plan. I'd love to hear your thoughts on this. Tell me in the comments if you've ever thought the market was rigged against retail traders. Stanley Druckenmiller, one of the all-time greats in macro trading. He managed billions at Duquesne Capital. And do you know what he said was his biggest frustration? Size. Because the larger you get, the harder it is to generate returns. And the data backs this up overwhelmingly. Academic research consistently shows that the largest hedge funds underperform their mid-sized peers. As funds grow past a few $1 billion, their returns compress. Doesn't sound dramatic until you compound that drag over a decade. The reason is simple. When you're managing $10 billion, entire markets become too small for you. You can't trade small cap stocks. You can't take a meaningful position in most Forex pairs without your own order becoming the liquidity event. Druckenmiller has talked openly about how size is the enemy of performance, that managing billions forces you into trades you'd never take with a smaller book. Let that land for a moment. One of the legends of trading is telling you that your small account is an advantage, not a limitation. Reason number 2, you don't answer to anyone. This is enormous and almost no one appreciates it. When you're a fund manager, you have investors, limited partners, people who gave you their money and expect quarterly reports, consistent returns, and explanations for every single drawdown. What does that mean in practice? It means you can't sit in cash. Even when the market is garbage, even when there's no edge, even when the smartest thing to do is absolutely nothing. Most fund mandates require being invested with minimum exposure requirements. If you're running a long-short equity fund, you can't just go flat and wait. Your investors would pull their money. They'd say you're not doing your job. So what happens is, fund managers take mediocre trades just to stay deployed. They call it putting money to work, but really they're trading without an edge because their business model demands it. You can sit in cash for 3 months and nobody cares, nobody calls you, nobody threatens to redeem their capital. You wait for the perfect setup with zero pressure. That freedom alone is worth more than any algorithm. Seykota, the legendary trend follower featured in Market Wizards, he ran his accounts from a house in Lake Tahoe, not a corner office, not a trading floor. A house by the lake. He'd check his systems once a day, sometimes less, and he generated returns that put most Wall Street firms to shame. One of his clients turned $5,000 into $15 million over 12 years, and Seykota's whole philosophy came down to this. Win or lose, everybody gets what they want from the market. Most fund managers don't actually want to outperform. They want to keep their jobs, gather assets, and collect 2% management fees. Their incentives are completely misaligned with generating alpha. But your only incentive is making money, with no politics, no career risk, and no committee meetings to decide whether to take a trade. When you have an edge, you exploit it completely. And this is where it flips, because reason number 3 is the one that really changes how you approach this whole thing. Reason number 3, you can trade any market, any time frame, and any strategy. That sounds simple, right? But for institutions, this is a nightmare. Most hedge funds are locked into a specific mandate. A macro fund can't suddenly start day trading penny stocks. A quantitative equity fund can't pivot to crypto overnight. Even if they see the opportunity of a lifetime in a market they don't cover, they literally cannot take the trade. Their legal structure won't allow it. Their risk models aren't calibrated for it. Their investors didn't sign up for it. But you have none of those constraints. Monday, you trade a breakout in Tesla. Tuesday, you're in a Forex pair. Wednesday, you spot a setup in Bitcoin and you take it. trend follower in the morning, mean reversion trader in the afternoon, 5-minute chart to the weekly chart based on what the market is actually doing. This flexibility is a massive edge. Markets are constantly changing. The strategies that work in January might fail in July. Institutions are slow to adapt, needing committee approval, model recalibration, and investor communication. But you just change. What's your experience with switching strategies? Leave your take below. The conversations down there are gold. Paul Tudor Jones tells a story about the 1987 crash, Black Monday, when the Dow dropped 22% in a single day, the largest one-day percentage decline in stock market history. Most institutions were paralyzed. Their risk models had never contemplated a move that large. Systems froze, phone lines jammed, pure chaos everywhere. But Jones, he had positioned his portfolio for the crash before it happened. He saw the warning signs and he acted on them. Why could he act when others couldn't? Because he ran a relatively small fund with absolute discretion, no committee, no approval process, and no compliance review. He saw danger and he moved. That's the kind of agility that size gives you. In a crisis, the biggest players are the most vulnerable. They can't liquidate without crashing the market further, trapped by their own size. Retail traders during major market events can flip from long to short in seconds. Hedge your entire portfolio in minutes. Go to cash and watch the carnage from the sidelines. During the most important moments in the market, your speed is your shield. Reason number 4, you have no career risk. This one is subtle but incredibly powerful. Think about what it means to be a portfolio manager at a major institution. Your entire career depends on one thing, not maximizing returns, not finding the best trades, but simply not blowing up. Don't be catastrophically wrong. What does that create? A culture of career preservation disguised as risk management. Fund managers don't take the best trades. They take the safest trades. They'd rather underperform the index by 1% than outperform it by 10% using an unconventional approach. Because if that unconventional approach fails, they lose their job, their reputation, and everything. There's a saying on Wall Street, nobody ever got fired for buying IBM. It means it's safer to lose money in a crowded trade than to make money in a lonely one. This creates massive herding behavior. Institutions pile into the same trades, the same sectors, and the same names, not because they're the best opportunities, but because they're the safest career moves. You don't have that bias. You can take the lonely trade, the contrarian bet, the one nobody else sees, and that is often where the biggest returns live. Mark Douglas wrote something in Trading in the Zone that perfectly captures this. He said the best traders have no fear, not because they're reckless, but because they've accepted the risk before they enter the trade. Institutional traders can do this, not fully. There's always someone looking over their shoulder, a risk committee, a compliance officer, an investor on the phone asking why the fund is down 2% this quarter. That constant scrutiny creates hesitation and second guessing. It makes traders take profits too early and hold losers too long. Because they're not managing trades, they're managing perception. When you trade your own capital with your own rules, you follow your system with complete clarity. No one is going to call you and make you close a winning trade because it makes them nervous. Absolutely no one. If you felt that in your chest, subscribe. We go deep on trading psychology every week, and this community is building something special. Reason number 5, and this is the one that ties everything together. Your costs are almost zero. A hedge fund has an army of expenses, office space in Manhattan or London, a team of analysts, each making $300,000 a year minimum. Bloomberg terminals, $25,000 per seat per year, plus legal counsel, compliance officers, prime brokerage fees, technology infrastructure, and administrative staff. By the time they turn on their computers in the morning, they need to make millions just to break even for the year. A typical hedge fund charges 2% of assets plus 20% of profits, the famous 2 and 20 model. On a billion-dollar fund, that's $20 million in fees before they've made a single trade. Their investors need to earn at least 5 to 7% just to match what a retail trader could achieve with zero overhead. Now here's you, with a laptop, an internet connection, and a brokerage account with near zero commissions. Maybe a charting platform. Maybe a data feed. All in, maybe $200 a month. Every dollar you earn is almost entirely profit. Institutions need massive returns just to cover their operating costs. But you're profitable on your first winning trade. Now here's the part most people miss. Having these advantages means nothing if you don't use them, and most retail traders don't. They throw away their size advantage by overtrading, throw away their flexibility by locking themselves into one market, throw away their freedom by checking P&L every 5 minutes, letting emotions dictate every decision. They throw away their zero-cost structure by paying for signal services, guru subscriptions, and overpriced courses. The reason most retail traders lose isn't because they don't have an edge. It's because they give their edges away. They try to trade like institutions, instead of leaning into what makes them different. The moment you start trying to compete with a hedge fund on their terms, speed, data, volume, you've already lost. But when you compete on your terms, with patience, flexibility, freedom, and low costs, they can't touch you. Jesse Livermore, perhaps the most famous trader who ever lived. He said something 100 years ago that still applies today. The game of speculation is the most uniformly fascinating game in the world. But it is not a game for the stupid, the mentally lazy, the person of inferior emotional balance, or the get-rich-quick adventurer. They will die poor. Livermore made and lost fortunes multiple times, but his core insight was always the same. The market rewards clarity, discipline, and self-awareness, not technology, not capital, and not connections, but clarity, discipline, and self-awareness. You have every tool you need to succeed. A small account that moves like water, no bureaucracy holding you back, the freedom to do nothing when nothing should be done, and a cost structure so lean that your competition needs 10 times your return just to match your profitability. The question isn't whether retail traders can beat institutions. The question is whether you'll actually leverage the advantages you already have. If this video changed how you think about your trading, send this to someone who needs it. Until next time, stay sharp.